Hello my fellow freedom builders and welcome back to the channel. Today's video is about one single company. It is the Dutch company ASML. That is a very high-tech company producing the products that help chip producers produce the chips that is needed in everything we use today. Now, if you don't want to see the entire video, I can give you a quick summary here. I think ASML looks very good and it is a potential buy and some good value. They have just been out with earnings today. That was not completely what people had expected, but it actually looks very good. Now, to the details. ASML, what are they making? They're making some products into photolithography, which is basically what helps chip producers making very small scale computer chips. Now, I'll not go too much into details with the technical details here, but I can tell you that if we just look here at Seeking Alpha, there are 4 different parts of the value chain, you could say, in chips. There are the customers. They're the ones we often hear about. That could be Tesla and Apple that put these chips into their products. There are the designers. That could be, for instance, Nvidia. That is also a company that have been a lot in the media on the semiconductor part here. Then there are something called the foundries. They are the factories that integrate the circuits in the world. The sector is highly oligopolistic, as they say, and the 3 main players are Samsung, Taiwan Semiconductors and Intel, and then there are the technology suppliers behind it all, and here we find ASML. That means that as long as you believe that AI is a thing, that Tesla is going to produce a lot of full self-driving cars at some point in time, as long as you believe Nvidia is going to keep making chips, then there is a high likelihood of ASML absolutely having a stellar business model. And if we take a bit of a look in Morningstar, that have some very good thorough analysis here, then I use them to get an idea of how wide the moat is for a company. The moat means how easy or hard it is for competitors to take over the market from this company. And they definitely say that the moat is wide, meaning that the technical level that ASML is at right now makes it, well, not impossible, but very hard for a new competitor just to come in and take over the market. This is a very high level of technical abilities that is needed to get in here. And it is not the same as, for instance, a shoemaker or someone making, I don't know, candy bars or whatever. It takes fairly low skills to make a candy bar or a pair of shoes, at least compared to this high level of tech. So the economic moat is high, meaning hard to compete with, or at least hard to get into this market. Now, when we look at the chart, it doesn't look too good. Meaning if you're a trend follower, you will have to think an extra time before going into this. Now, ASML have been a fantastic business to be invested in. Then it had a downturn here in 21-22, had a great 23 along with all the other big tech that went up here in 23. And now they have broken a trend line, if you draw that one somewhere here on the weekly chart. And right now it actually turns down. As you can see here on the earnings today, there was a 4% positive surprise on the earnings per share, but a 1% negative surprise on the revenue. I haven't had time to read the earnings report in depth. I will do that later today. But as you can see, the market they're not taking this completely positively here. They are sending the stock a bit down. If you are a true in the bone value investor, well, then this might be actually the time to buy. We'll have a look at that just in a second. But if you are a trend follower and you're looking at are the big guys going into or out of this market, you would do something like this and say, nah, not right now. Let me wait until we have a bit of a better trend. But let's jump into my stock scanner and have a quick look at the stock. Now, the total revenue here, as you can see, 2017 was $9 billion. Now we are reaching $27 billion, and that is just growing and growing. Earnings per share is growing very nicely. We can see that the PEG ratio is just about 2, meaning that you're not paying too much for future value here. Altman C score is fantastic. We have the return on capital employed. That is 30%. We can see up here in the quality. Return on capital, return on equity, and operating margins are stellar. Actually, the 34.6% here, many analysts are expecting this to move up towards 40% in operating margins. And if that is true, that's about a fifth higher operating margins. And that, of course, combined with a rising revenue, that gives some very, very good earnings per share potentials. The free cash flow is great, and basically it just looks good. A lot of working capital. There are not really any severely red flags here that would make me think that this is a dangerous one to buy. Quick look at the TPI chart. Let's just have a quick look here. As you can see here, if you're a trend follower, the long-term trend is red, so that is a no-go right now if you are into trends. But we can also see that had you employed this trend following part here, you could have gotten in here around the 250, 60-ish and out somewhere up here in triple the price. So that would have been a very good stock, and it might just be that again. Going into the value chart, we can see here, if we just start in the next two earnings report here, like this, there is a potential 11% per year in CAGR, meaning a 14% in the next, a year and a quarter, something like that here. But if we go a bit further out in time, let's say 3 years more than that, and we are applying about, let's just say a 10% growth per year. That is actually below of what many analysts are estimating, but let's just say we have a 10% growth in earnings rate here. That'll give you a 10% per year. Now that is at a price earning of 29.5, and as you can see, in 10 years, 5 years, and 3 years, it has been significantly higher. Let's just be a bit conservative and put it at 32, for instance, here, and let's have the earnings that the analysts are actually estimating that they could fairly easy get, and that is 15% growth in earnings per share per year. You can see they're having 19.6 and 14 here, so 15 is not completely out of the question. That will give you over the next 4 years and a quarter, something like that, and 87.8% growth in the price, meaning 15.6% per year. Now, are these numbers certain? No, absolutely not. Anything can happen. The PE can drop, the earnings growth can drop, but even if they did, even if the earnings growth was only 5%, and let's say that the PE dropped to 25, which it hasn't been for the last 10 years or so, you would still get a decent 2.6 per year. That is not a lot, but that is with numbers a lot lower than what any analysts are estimating here. So even in a very, very bad case where competitors are swamping in on the market and the investors are nervous, so they're sending the PE down, even there you wouldn't lose a ton of money. So this is, of course, not a safe bet because nothing is in the stock market, but it is a very, very interesting stock and definitely one I am considering putting into my long-term portfolio. That's all for now. Pure inspiration, and remember to put your own risk management and your own strategies into the considerations of what you are investing in. Until next time, take care of yourself and your money out there, and I'll talk to you again shortly. Bye.